It really feels like the whole conversation around companies has shifted lately. I mean, profit's still vital, obviously, but
Yeah, but there's this growing focus on the bigger picture, right? The actual impact businesses have
yeah.
beyond just the financials.
Exactly. It's like we're all looking much closer now at, well, how they operate in the world.
That's right. We're definitely seeing a fundamental change in how we look at corporate value. It's expanding beyond those traditional metrics to really try and grasp their environmental footprint, their social impact.
Which is the perfect setup for what we're digging into today. ESG, that's environmental, social, and governance, and this whole wider idea, sustainability.
Mhm.
So if you've heard these terms thrown around, maybe seen the acronyms, and you want to get past the buzzwords, really understand what they mean and why they're becoming so important, well, you're in the right place.
Absolutely. And the materials we're drawing from today, they're actually from some pretty comprehensive course content. So they give us a really structured way into
Oh,
this.
nice.
Yeah, they start with the basics, the definitions, and then move into how this stuff actually works in the real world. And there's a particularly good focus on the African context, which is really insightful.
Okay, great. So our mission for this deep dive is pretty clear then. Unpack ESG and sustainability, figure out how they relate, why they matter so much now, and importantly, look at how different places are adopting them or maybe struggling with them a bit.
Sounds like a plan.
All right, let's jump in. Kicking things off, sustainability. What are we actually talking about when we use that word?
Okay, so sustainability at its core is really about, well, meeting our own needs right now
Mm-hmm.
without messing things up for future generations trying to meet their needs. It's this idea of
The
balance.
balance between what exactly?
Three main things, really. Environmental protection,
Mhm.
looking after the planet, resources, not polluting too much. Then there's social responsibility or social equity, fairness, opportunity, treating people well. And finally, economic viability, making sure growth can happen, but in a way that doesn't just drain resources or wreck ecosystems down the line.
Right. So it's not just about being green, it's people and profit too, but all working together long term, like thinking about the whole farm, not just this year's crop.
Exactly. That's a good way to put it.
Okay, so that's sustainability. Now, this term ESG, it seems like it's everywhere when people talk sustainability. Is it just like another word for the same thing?
Yeah, that's a really common point of confusion, and it's important to get it clear. They're definitely related, but not quite interchangeable.
Okay.
Think of sustainability as the big overarching goal, that long-term balance we just talked about. ESG, on the other hand, is more like the framework. It gives us the concrete criteria to measure and report on how companies are actually doing on their journey towards that sustainability goal.
Ah, I see. So sustainability is the destination, maybe, and ESG is kind of the map or the dashboard showing how we're getting there.
Precisely. ESG looks at a company's performance through three specific lenses: the E for environment, the S for social impact, and the G for governance, how the company is run. It's a tool, really, for gauging ethical commitment, progress towards sustainability, and, crucially, for investors and the companies themselves, it's about assessing long-term value creation and managing risks and opportunities.
Right, okay. That clarifies things a lot. We've got the what, now the why. Why should companies or even us as individuals maybe really be paying attention to all this ESG and sustainability stuff? What's the real driver here?
Well, there are quite a few compelling reasons, and they're becoming increasingly hard to ignore. For businesses, a huge one is risk reduction, or risk management maybe. How? By actively looking at these E, S, and G factors, companies can spot potential problems before they blow up. We're talking environmental fines, social backlash, governance scandals, things that can really hurt, both immediate risks and ones lurking further down the road.
Yeah, that makes total sense. You ignore pollution laws or treat your workers badly, it's bound to catch up with you eventually, right?
Absolutely. But it's not just about dodging trouble. There's also a big opportunity side to this.
Oh, like what?
Well, thinking sustainably can actually spark innovation. It can help companies identify unmet needs in the market, maybe for greener products or services for communities that have been overlooked. It can open up whole new customer bases.
Huh. So being more responsible could actually lead to new business. That's interesting.
Definitely. And companies that get this right, that have strong ESG performance, they often find they have a competitive advantage. They become more attractive.
To who? Customers, investors.
To pretty much everyone, really.
Yeah.
Customers, investors, regulators, even potential employees. It builds better relationships all around, strengthens what they call the social license to operate.
And I guess that positive feeling spills over into their general reputation.
Exactly right. Good ESG practices build a stronger brand, enhance that reputation. And linking back to what I just said, it's also huge for talent. People increasingly want to work for companies that, reflect their own values, that seem to be trying to do the right thing. It helps attract and keep good employees.
It really does feel like it all connects. Better reputation, happier employees, potentially new markets, lower risks. It paints a compelling picture. Now, this ESG focus, it feels quite current, but it didn't just appear out of nowhere, did it? The sources mentioned an ESG journey. Can you give us the quick history?
Sure. Yeah, it's definitely got roots going back away. You can trace it back to the 60s and 70s, really, with the rise of environmental awareness and the Rachel Carson's silent spring and more social activism.
Okay, so early consciousness raising.
Right. Then in the 90s, you started seeing the rise of SRI, socially responsible investing. Investors began thinking, hang on, maybe we should consider ethics, not just profit. Plus, there was more scrutiny on how big companies behave globally. That's when you saw things like the Dow Jones Sustainability Index pop up and the UN Global Compact.
So the investment world started taking notice.
Exactly. The 2000s were a key decade. That's when the actual term ESG got coined and started being used more widely. And the UN Principles for Responsible Investing launched, giving it a more formal structure.
Okay, so the acronym itself is relatively recent-ish.
Yeah, in the grand scheme of things.
Yeah.
Then the 2010s really accelerated things. You had Paris Agreement on Climate Change, the UN Sustainable Development Goals, the SDGs, big global commitments. Plus, things like the Business Roundtable statement in the U.S. where CEOs started talking about stakeholder value, not just shareholder value. And importantly, a whole load of different ESG reporting frameworks started appearing.
Wow, okay. So it's been a steady build-up over decades, really gaining momentum in the last 10, 15 years. You mentioned those three pillars again, E, S, and G. Let's just quickly unpack those a bit more. Environment, the E, what's typically included there?
So environment is all about the company's impact on the natural world. Big topics here are climate change, their greenhouse gas emissions, their strategy to reduce them, their exposure to climate risks. But it also covers biodiversity loss, resource depletion like water usage, pollution, and waste management, basically their whole environmental footprint.
Got it. And S for social. That sounds like it could cover a lot.
It does. Social is about how a company manages its relationships, primarily with its people. So labor practices, health and safety, diversity, equity, and inclusion, or DEI, but also its relationship with the wider community, with its suppliers ensuring ethical practices down the chain, and even with its customers. Things like data privacy and product safety. Human rights is a big cross-cutting theme here, too.
Okay, broad but crucial. And finally, G for governance. What's the focus there?
Governance is all about how the company is run. Its leadership structure, board independence, executive pay, shareholder rights, internal controls, auditing, transparency, ethics. Essentially, is the company managed responsibly, ethically, and with proper oversight? Risk management often falls heavily under G as well.
Right, making sure the house is in order ethically and structurally. Now, the sources flagged some specific environmental risks that are really pressing right now. What are the big ones we need to be aware of?
Yeah, the environmental picture has some serious challenges. Climate change is obviously huge, manifesting in more extreme weather, the hurricanes, heat waves, major floods. We're seeing those more and more.
Definitely feels that way.
Then there's biodiversity loss,
Yeah.
a decline in the variety of life on Earth, which has massive knock-on effects for ecosystems and even economies. Freshwater depletion is another critical one. Water scarcity is a major challenge for sustainable development globally.
Water is fundamental. What else?
Pollution, definitely. Air, water, soil pollution. It's a massive risk to human health, kills wildlife, and contributes to climate instability too. And finally, something maybe less talked about but still critical, ocean acidification. The oceans absorb a lot of our excess CO2, and that's changing the water chemistry, which is really bad news for marine life, especially things with shells, like coral reefs and shellfish.
That's quite a sobering list. It really highlights the scale of the environmental challenge. So, flipping that around, what happens if companies just ignore this stuff? What are the real risks of not taking ESG seriously?
Oh, the downsides are becoming increasingly tangible. Operationally, they risk things like investors pulling their money out divestment, or finding it harder or more expensive to borrow money.
Yeah.
Lenders are looking at this now too.
Okay, direct financial hits.
Yes. And then there's reputation. Huge risk. Bad press about an oil spill or sweatshop labor or a governance scandal that can trash a brand's value incredibly quickly.
We've all seen examples of that, haven't we?
Absolutely. Supply chains are another vulnerability. Think about disruptions from climate-related disasters, or finding out your supplier is using child labor. That's a massive risk. Financially, there are straightforward things like fines and legal penalties for not complying with environmental or social laws. And regulatory risk is growing everywhere. Governments are bringing in more rules around ESG all the time.
So it's hitting the bottom line, the brand, operations, legal, pretty much everywhere. It's definitely not just nice to have anymore. It sounds essential.
That's exactly the point. It's moving from the margins to the mainstream of business strategy.
Okay, so it's clear why ignoring ESG is risky. Let's talk about the positive side again, the business case for embracing it. How does this actually create value? You mentioned materiality earlier. Tell us more about that.
Right, materiality is key here. It's basically the process of figuring out which ESG issues are most important, most material to a specific company or industry.
Yeah.
And there are different ways to look at it. There's financial materiality. This focuses on ESG issues that could reasonably be expected to affect a company's financial performance, its cash flows, access to finance, cost to capital, stuff that directly hits the bottom line.
So, like, how investing in energy efficiency saves money on bills, or how avoiding environmental fines protects profits.
Exactly. Then there's impact materiality. This looks at it from the other direction. What impact does the company have on the environment or society? This is about the company's outward effect, positive or negative, regardless of whether it immediately shows up on their balance sheet.
Ah, okay. So one is outside in, how ESG affects the company. The other is inside out, how the company affects the world.
You've got it. And increasingly, there's talk of double materiality. This says companies need to consider both. They need to report on how sustainability issues affect their business and how their business affects people and the planet. It reflects this growing expectation for broader accountability.
That makes a lot of sense. You need both perspectives for a full picture. So based on this idea of materiality, how does doing ESG well actually generate value for a company?
It works in a few key ways, often grouped into strategic, financial, and operational benefits.
Okay, let's break that down. Strategic.
Strategically, like we touched on, it enhances brand reputation. It can drive innovation, new sustainable products, new business models. It helps mitigate those risks we talked about. It can even increase market share as consumers choose more responsible brands. And it makes companies more resilient, technologically and strategically.
Sounds like building a stronger, more future-proof business. What about direct financial gains?
Financially, strong ESG performers often find it easier to access capital, sometimes at a lower cost. Investors see them as less risky, more forward-thinking, so it can boost investor confidence. Operationally, there are often cost savings, energy efficiency, water reduction, less waste, and it ensures you're keeping up with regulations, avoiding those fines.
And the operational side overlaps there a bit, right? Cost savings, compliance.
Yeah, definitely overlaps. Operationally, you get those cost reductions from resource efficiency. Compliance helps avoid disruptions. Being sustainable can also make you more resilient to market shocks, like fluctuating energy prices. It just makes the whole operation smoother, often leaner.
It really does sound like it permeates almost every aspect of the business if done right. The sources also mention building loyalty with customers, with investors. How does that connection work?
Well, strong ESG performance builds credibility, doesn't it? But it also taps into something more emotional. People want to associate with companies that align with their values. So customers might be more loyal, willing to pay a bit more even. And for investors, it's not just about values. Good ESG signals good management. It shows the company understands complex risks, is thinking long-term, is likely more resilient. That builds trust and confidence, leading to stickier, more loyal investors.
Makes sense. It's about aligning values, but also demonstrating sound management of future risks. Okay, thinking about how companies approach this, are there different overall strategies they might adopt?
Yeah, the sources kind of outline two broad approaches. One is defensive. This is more reactive. Companies might adopt certain practices mainly to mitigate specific risks, like complying with new environmental laws just to avoid penalties. It's about protecting value, maybe, rather than actively creating it through sustainability.
So, ticking the boxes, meeting the minimum.
Kind of, yeah. The other approach is offensive. Here, sustainability is right at the core of the strategy. It's seen as a driver of innovation, a way to create new value, gain competitive advantage. They're proactively looking for opportunities through sustainability, not just dodging bullets.
That sounds much more transformational, embedding it right into the business model. Okay, let's shift gears slightly to the investment world. How is all this ESG thinking actually changing how people invest money?
Oh, it's having a huge impact. We're seeing a massive growth in sustainable investing, and it takes several forms. One common approach is screening.
Screening, like filtering.
Exactly. You apply rules to include or exclude certain investments.
Yeah.
So negative screening avoids companies involved in things like tobacco, weapons, maybe fossil fuels. Positive screening actively seeks out companies that score well on specific ESG criteria.
Okay, setting basic rules. What else?
Then there's ESG integration. This is more sophisticated. It's about systematically weaving ESG factors into your mainstream financial analysis. You're looking at how ES and G issues might affect a company's risk and return profile alongside traditional financial metrics. It's becoming pretty standard practice for many big investors.
So adding another layer to the usual
Right.
analysis.
Then you have thematic investing. This is where you invest specifically in trends related to sustainability, things like clean energy, water technology, sustainable agriculture, education technology. You're betting on those themes growing.
Focusing on specific solutions.
Yep. And finally, there's impact investing. This is maybe the most intentional approach.
Mm.
The primary goal here is to generate a measurable, positive social or environmental impact alongside a financial return. It's not just about avoiding harm, it's about actively doing good with the investment.
Right, so finance as a tool for positive change, not just profit. Interesting spectrum of approaches. Now, thinking about the E again, how do these sustainability ideas apply to designing the actual products companies make?
Yes, sustainable product design is a really important piece. It means thinking about sustainability right from the start, across the whole life cycle. Key things include resource efficiency, using fewer materials, designing out waste.
Making more with less.
Exactly. Energy efficiency, making products that use less energy when they're running, but also thinking about the energy used to make and transport them. Longevity and durability are huge, making things that last longer, reduces waste and resource use.
The opposite of planned obsolescence.
Precisely. Then there's end-of-life planning. What happens when the product's finished with? Can it be repaired, reused, recycled easily? Thinking about that up front. User-centric design is important too, making sure it actually meets user needs effectively so it doesn't get discarded prematurely. And overarching all this is aiming for minimal environmental impact throughout that whole life cycle, from sourcing raw materials to final disposal.
So, a really holistic view of the product's journey. Okay, we've talked about why ESG matters, what it involves, what are the main things driving its adoption now? Why is it gaining so much traction?
Several big forces are pushing this forward. Regulations and policy are definitely one. Governments are stepping up with mandates, disclosure requirements, things like carbon pricing. International agreements like the Paris Agreement and the SDGs set the direction too.
The stick, basic art.
Partly, yes. But there's also massive investor pressure. Big pension funds, asset managers, they're demanding better ESG performance and disclosure. The growth of sustainable finance green bonds, ESG funds is fueling this too. It's the market sending signals.
So the money is talking.
Loudly. Consumer expectations are another driver. People are more aware. They want to buy from responsible companies. Brand reputation matters. And finally, technology is an enabler. New tech makes it easier to measure environmental impact, manage resources efficiently, improve transparency in supply chains. Innovation is helping make sustainability more feasible.
So regulation, investors, customers, and technology, quite a convergence. But it can't all be smooth sailing. What are the big roadblocks? What stops companies from fully embracing ESG or getting the long-term value from it?
Yeah, there are definitely hurdles. Sometimes it's internal. A lack of good processes or metrics, it's hard to manage what you can't measure properly. A lack of real commitment from the top, from the board, can kill any initiative. If the board isn't bought in, it's tough.
Needs that leadership buy-in.
Absolutely. Sometimes the company's main business strategy or growth targets just aren't aligned with sustainability. They might conflict. And sometimes a lack of diversity on the board can mean they don't have the perspectives needed to really understand or prioritize complex ESG issues.
Right, so internal alignment, leadership, and having the right measurement tools seem crucial. Okay, this is fascinating. Now, you mentioned the sources really dive into the African context. Let's zoom in there. How is ESG playing out across the continent? It must be quite varied.
Hugely varied, yes.
Yeah.
Africa is incredibly diverse, and the ESG landscape reflects that. The sources give us some good snapshots. Let's start with, say, Kenya.
Okay, Kenya. What's the regulatory picture like there?
Kenya's actually been quite proactive in some areas. The Capital Markets Authority has ESG guidelines for listed companies. There's the Companies Act pushing good governance. And they've developed a green finance taxonomy, basically a classification system for green investments, which is set to become mandatory for banks from October 2026.
So formal steps being taken. What trends are we seeing in terms of actual adoption?
We're seeing definite growth in green finance. Banks like KCB, Equity Bank, we'll talk more about KCB later, are building ESG into lending. Lots of interest in renewable energy investment. Agriculture is seeing some moves toward sustainable practices. And they have a green bond program to channel funds.
Sounds like momentum.
Hmm.
What are the big opportunities for Kenya in pushing ESG further?
Huge potential to attract more green investment, obviously.
Mm-hmm.
Expand that renewable sector, generally strengthen compliance across the board, grow the circular economy, dealing with waste better, and leverage tech things like blockchain for transparency, maybe IoT for smart farming.
Lots of potential. But the challenge is, what's holding Kenya back?
Well, reporting is still a bit patchy, inconsistent sometimes. Compliance can be costly, especially for smaller businesses. Just general awareness and expertise need more capacity building, and they face real climate risks, like droughts plus pollution issues. Governance and social issues always need attention too. And like everywhere, the risk of greenwashing companies talking a good game without real substance.
Right, the substance gap. Okay, Kenya sounds like it's moving but facing hurdles. Let's head south to Tanzania. What's the situation there?
Tanzania's got its Environmental Management Act from way back in 2004, plus capital market governance rules. More recently, they brought in carbon trading regulations in 2022, and the Bank of Tanzania just implemented climate and sustainability risk guidelines for banks in January 2025. So the financial sector focus is emerging there too.
Okay, financial sector regulations kicking in, trends on the ground.
The Association of Tanzania Employers put out a report in late 2024 trying to guide businesses. We're seeing some uptake in agriculture and energy. The Ag Development Bank started ESG training. They've landed some significant climate finance deals. But there are also some tricky issues bubbling up around indigenous rights, clashing with conservation or carbon credit projects, like near the Serengeti.
That really highlights the social complexity. What are Tanzania's main ESG opportunities?
Well, they've got incredible natural resources and biodiversity, big potential for sustainable tourism, maybe responsible carbon credits. Accessing more international climate finance is key. Growing the green economy, sustainable farming, renewables, and generally using ESG to become more attractive to investors.
And the main roadblocks in Tanzania.
Gaps in mandatory reporting are still an issue. Those land rights and indigenous issues are complex and sensitive, potential for greenwashing again, and sometimes infrastructure or tech limitations, especially outside the main cities, can hinder adoption of green practices.
Okay, complex picture there too. How about Rwanda? They often get highlighted for governance.
Yes, Rwanda's taken a very structured approach. They launched a national ESG framework in 2024, aiming to align with global standards. They developed a green taxonomy in 2023 and a sustainable finance framework in 2024 to guide green bonds. The Bankers Association, working with the IFC, brought in ESG guidelines for banks in 2024, and ESG is now explicitly in their corporate governance code.
Wow, this sounds very comprehensive and quite recent. What trends are flowing from that framework?
Well, the framework launch itself, October 2024, was a big signal aiming to attract investment. The Capital Market Authority is pushing ESG reporting for listed firms. Banks have those new guidelines. They're actively building out the green taxonomy, sector by sector. And you see concrete projects like the Kigali Green Complex showing sustainable construction principles in action.
Seems like strong top-down direction. What are the opportunities this creates for Rwanda?
It definitely boosts their investment appeal and competitiveness. The banking rules promote responsible finance. It helps Rwandan businesses align with global expectations. They're positioning themselves as an ESG leader in the region, which also creates demand for local sustainability expertise and advisory services.
And the challenges Rwanda faces despite this progress.
They still grapple with underlying issues like climate vulnerability, population pressure, unemployment, the need for economic growth, which can create tensions with ESG. Geopolitics around minerals trade can complicate ethical sourcing. Specific environmental risks, like managing methane extraction from Lake Kivu sustainably. And ensuring minerals aren't coming from conflict zones requires really robust due diligence.
So even with a strong framework, those deep-seated challenges remain. Okay, last one in this East Africa tour, Uganda. What's the ESG story there?
Uganda seems to be at an earlier stage compared to the others we've discussed. There isn't really a single, comprehensive national ESG framework yet, though existing laws touch on aspects. But things are moving. The Bank of Uganda brought in rules in December 2024 requiring banks and financial institutions to integrate ESG principles.
So again, the financial sector seems to be a key entry point.
It often is. So while some big international companies operating in Uganda are incorporating ESG, many local businesses are just starting, partly because there haven't been strong national requirements, Or maybe the awareness level is still building.
What specific trends are visible then?
That Uganda Bankers Association paper from December 2024 was significant, pushing ESG integration. The stock exchange is working on improving ESG disclosure among listed companies. The Bank of Uganda is encouraging ESG in lending, and the insurance regulator is nudging insurers the same way. So finance and capital markets are definitely focal points.
What are the potential upsides for Uganda if they accelerate ESG adoption?
Big opportunity to unlock growth by aligning with global standards. ESG practices can drive efficiencies, cost savings, innovation. Sustainable agriculture is obviously huge for Uganda's economy and environment. And tackling social and governance gaps through an ESG lens could help reduce inequality and foster more inclusive development.
And the main hurdles Uganda needs to overcome.
There's been criticism over the impacts of some large infrastructure projects, highlighting a need for better ESG integration from the start. Deforestation is a major environmental concern. A key issue is often weak enforcement of existing environmental and social laws. If rules aren't enforced, the incentive to comply is lower. And generally, it's just early days needing more awareness, capacity, and a clearer, consistently enforced regulatory direction.
It's really striking how different the pace and focus are, even within one region like East Africa. Each country has its own path. Now, zooming out to the whole continent, what broader trends or examples do the sources mention?
Yeah, across Africa, you see diverse activity. In Southern Africa, South Africa's had a carbon tax for a while now, plus big pushes on renewables alongside Namibia and Botswana. And South Africa's ongoing focus on broad-based Black economic empowerment has strong social governance elements.
Okay. West Africa.
Nigeria's got a Climate Change Act aiming for net zero. Ghana has a Renewable Energy Act. The Nigerian Stock Exchange has ESG guidelines. Central Africa is crucial for its rainforests. The Congo Basin carbon sink in Gabon, DRC. There's also some focus on improving worker protections in certain sectors there.
And North Africa.
Countries like Egypt and Morocco have national sustainability strategies. Egypt's Vision 2030, for instance. Growing financial inclusion, often driven by fintech, is a key theme with sustainability links.
So a real patchwork of initiatives. What are the big overarching opportunities for the continent if it embraces ESG more fully?
Huge potential for sustainable, inclusive growth, directing investment better. Improved access to global markets and finance, as ESG becomes more of a requirement. Attracting climate finance for renewables and adaptation. Building trust and enhancing reputations. Creating jobs in green sectors. Driving infrastructure improvements, and fostering homegrown green innovation.
Sounds incredibly promising, but the continent-wide challenges must be significant too.
Absolutely. The large informal economy in many countries makes formal ESG tracking and regulation really difficult. Limited access to capital hinders investment in sustainable practices, especially for smaller businesses. There can be real tension between immediate development needs, like poverty reduction and long-term ESG goals. Sometimes global ESG standards don't quite fit the local context perfectly. Weak governance or lack of enforcement capacity is an issue in some places. Shortages of local ESG experts, unreliable data for reporting, and political instability can all impede progress.
Yeah, those are deep, systemic challenges. It really underscores that you can't just import a model. It needs local adaptation. The sources also give a quick global snapshot beyond Africa. Any key highlights from other regions?
Sure. North America?
Yep.
The U.S. has its new SEC climate disclosure rule. Mexico's undergoing labor reforms. Canada's TSX has ESG policies. Australia, net zero target, strong inclusion focus, ASX pushing reporting. Europe, very ambitious with net zero goals, the Carbon Border Adjustment Mechanism, CBAM, and the big Corporate Sustainability Reporting Directive, CSRD, rolling out.
Europe seems quite far ahead on regulation. Asia.
Asia's diverse, too. China's huge on renewables and has a net zero goal. Japan and Korea are increasingly focusing on diversity and inclusion, D&I. Stock exchanges across the region are bringing in disclosure rules. Latin America, Brazil's often seen as an ESG leader, tackling deforestation, strengthening indigenous rights in places like Colombia and Peru, too. Brazil's B3 exchange mandates ESG reporting.
So definitely a global trend, but with regional flavors and priorities. What are the big universal opportunities and challenges playing out worldwide?
Globally, the opportunities are similar to Africa's, but on a larger scale. Driving sustainable growth, better capital access, reducing environmental harm, building stakeholder trust, transitioning to a green economy, upgrading infrastructure, fostering public-private partnerships.
And the shared headaches.
Big ones include inconsistent standards across jurisdictions, makes it hard for global companies. Lack of capital for SMEs to invest in ESG is a worldwide issue. Short-term financial pressures often clash with long-term sustainability thinking. That lack of standardized reporting is still a problem, despite progress. Weak governance isn't unique to any one region. A global shortage of ESG expertise, resistance to change within companies, and, of course, geopolitical risks that can disrupt everything.
It really does feel like a massive global transition in progress with all the opportunities and growing pains that involves. Okay, so for an organization listening to this, maybe feeling a bit overwhelmed, thinking, where do we even start? What are the first
It's
steps?
a good question. The key is not to try and boil the ocean immediately. First step, assess and prioritize. Figure out what ESG issues are actually material to your specific business and stakeholders. Do that materiality assessment.
Focus on what matters most to you.
Exactly. Second, set clear goals. Based on that assessment, establish some specific measurable targets. What do you actually want to achieve and by when? Third, embed ESG into the business. Start integrating these considerations into your policies, your supply chain management, how you develop products, your everyday operations. It can't be a separate department. It needs to be part of the fabric.
Make it part of the day job.
Right. And fourth, monitor and report. Track your performance against those goals. Be transparent about your progress and your challenges. Communicate what you're doing.
And there are tools to help with that reporting part, frameworks you mentioned.
Yes, quite a few. And the landscape is evolving. On the voluntary side, you've got established ones like GRI, Global Reporting Initiative, very comprehensive on impacts. TCFD, Task Force on Climate-Related Financial Disclosures, focus specifically on climate risks and opportunities. ASB, Sustainability Accounting Standards Board, provides industry-specific standards focusing on financially material topics. CDP, formerly Carbon Disclosure Project, strong on environmental data like carbon, water, forests. And GRESB for real estate and infrastructure.
Okay, quite a list of acronyms already. Any mandatory ones emerging?
Yes, that's a big shift. The IFRS Foundation has launched IFRS S1 and S2. These are global baseline standards focused on sustainability-related financial disclosures, aiming for consistency. And the EU's Corporate Sustainability Reporting Directive, CSRD, is a major one, requiring detailed sustainability reporting from a large number of companies operating in Europe using new European Sustainability Reporting Standards, ESRS.
So the reporting side is getting more formalized, and in some places, mandatory. Must be challenging to navigate all that.
Definitely. Some key challenges companies face with disclosure include dealing with unstructured data. Lots of ESG info isn't easily quantifiable or comparable. The mix of voluntary and mandatory rules creates complexity and cost, and under voluntary regimes, companies might cherry-pick what they disclose. And relying on third-party ESG rating agencies can be tricky, as they all use different methods, leading to sometimes confusingly different scores for the same company.
Yeah, that ratings inconsistency is something you hear about a lot. Okay, to make this all feel more concrete, the sources gave a case study. Kenya Commercial Bank, KCB, you mentioned them earlier. What are they doing on the E environment?
KCB is a really interesting example in the African context. Environmentally, they've made a huge commitment to green finance, over 336 billion Kenyan shillings allocated to things like renewable energy, energy efficiency, sustainable agriculture, clean transport.
Wow, that's a serious number.
It is. They've also set science-based targets for their own emissions, aiming for net zero by 2050, halving emissions by 2030, aligned with the SBTI initiative. They have a sustainable lending policy where they screen larger loans, above USD 2 million, for E&S risks using international standards, like the IFC performance standards.
Yeah.
And internally, they're working on their own footprint through energy efficiency, digitization, etc.
So looking at their financing and their own operations, what about the social initiatives?
Big focus on financial inclusion. They've reached millions through mobile banking, like KCB M-Pesa and their agent network, providing access to credit and savings. They run youth empowerment programs to Jajiri and Mifugo ni Mali, offering training and funding. Education is another area they've sponsored over 1,000 students through scholarships. And they invest in communities, health projects, disaster relief, COVID recovery support, plus environmental stuff like tree planting, over 250,000 trees, apparently.
Seems like a broad range of social contributions. And finally, JAWS governance and ethics at KCB.
They've embedded sustainability right at the top, with a dedicated board-level sustainability committee overseeing everything. They emphasize transparency in their reporting using multiple frameworks like GRI, TCFD, SESB, aligning with the SDGs, and publicly disclosing their climate risks and performance. And they have a supplier code of conduct, pushing sustainability standards down their supply chain.
KCB really does sound like they're trying to integrate ESG across the board. It's a helpful real-world example. Okay, we've covered a massive amount of ground here. As we wrap up this deep dive, what are the absolute key things you think listeners should take away?
I think the main thing is that ESG and sustainability,
Hmm.
they're not just niche topics or trends anymore. They're really fundamental to how businesses need to operate for long-term success and, frankly, for societal well-being.
It's become core business strategy.
Exactly. And the second key thing is the interconnectedness. You can't really separate the E, the S, and the G. They all influence each other. Tackling climate change involves social justice. Good governance enables better environmental and social performance. You need that holistic view.
And it's definitely not simple, as the regional example showed.
No, not at all. It's a journey, right? There are huge opportunities for innovation, for growth, for positive impact. But there are also real challenges. Data gaps, costs, resistance to change, context matters hugely, as we saw comparing Kenya, Tanzania, Rwanda, and Uganda. It requires ongoing effort and adaptation.
So, a final thought maybe for you, the listener. How might these ideas, ESG, sustainability, shape your own choices? Whether you're buying something, deciding where to invest, or thinking about your work, what does this mean for the kind of future we're building? Maybe explore some of those frameworks we mentioned, or look up what companies you interact with are doing. It really feels like, as we said at the start, this conversation is only going to get bigger.